Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, September 30. The markets are calm, waiting for the US jobs data and potential US government shutdown. The US dollar remains under pressure. Gold and silver extend their rally while crude oil is offered on hint of further OPEC supply. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the week started with minor gains in US and European indices despite fresh tariff threats from Donald Trump and no material progress on talks to avoid a potential US government shutdown by tomorrow. So the S&P 500 and Nasdaq traded quite flat near their all-time high levels, while the US 10-year yield fell on safe haven inflows into the US 10-year papers. A US government shutdown by tomorrow is a real possibility now, though it won't be the first nor the last time the US government shuts down on funding issues as such. I think that a short period of shutdown in US government wouldn't have a major impact on US growth, nor the US growth expectations, nor the global risk appetite. It will be just a small bump on the road. What's more worrying investors, though, is the risk of US data not being released or being delayed in the next few days, and the lack of economic data from the US would muddy the Federal Reserve outlook. And because the softening Fed outlook and the rising Fed rate cut expectations have been a major support for the risk appetite and for the latest US stock market rally, the lack of economic data from the US could encourage some investors to take profit and move toward the sidelines. That is the biggest risk in the short run. And in the longer run, if the US government shutdown lasts a few weeks, for example, which is also a real possibility, it has happened before, then the US growth expectations will start to deteriorate. But then the deterioration in US growth expectations would boost the Fed rate cut bets, and that magic mechanism of dovish Fed expectations would then throw a floor under any potential market sell-off. So, in summary, I wouldn't be too much worried about a potential shutdown of the US government in the medium run from a market perspective. I would rather see potential price pullbacks in the short run as well, interesting opportunities to buy them. Now, speaking of data, because today could be the last day of data release in the US and the business as usual setup, the job openings data could be given more attention than usual. So the job openings in the US are expected to have further decline in the month of August, and a softer than expected jobs figure today could eventually help bolster the Fed dollars and further weigh on the US yields, the US dollar, without, however, boosting appetite for the US stocks as the US government shutdown risks are looming right now. In Asia, however, appetite for Chinese stocks remains intact, mind you, after the latest PMI data in China hinted that the Chinese manufacturing activity hit the strongest levels in 6 months. New export orders indeed rose for the first time in 6 months. New business expanded at the fastest pace since February. Supply conditions improved and input cost inflation accelerated to a 10-month high level driven by higher metal prices. On top, the Chinese government said that it will deploy 500 billion yuan, so the equivalent of 70 billion US dollars in capital, to further back investment to boost growth in China. So appetite is improving for Chinese equities as momentum is picking up and building stronger. Foreign holdings of Chinese assets are also expanding for the very first time in 4 years, mostly shouldered by the Chinese technology giants, obviously, and this AI rally. And indeed, Alibaba gained up to 130% since the beginning of this year, while the Hang Seng Index in Hong Kong, that is heavy with these Chinese technology stocks, rebounded up to 43% since January to the levels last seen in 2021. But still, despite the recent inflows into the Chinese equities, global investors remain relatively little exposed to Chinese stocks, meaning that there is still further room for the rally to develop in these Chinese stocks, especially the Chinese technology assets. And the Chinese technology stocks, despite decent rally this year, remain cheaper than their US peers where valuation this way. Now, the high valuation in US big tech have not necessarily been a barrier to further rally, mind you, but data here suggests that leveraged ETFs, so the ones that double or triple the daily moves in indices or single stocks, saw $7 billion of outflows in the month of September, which is actually a warning that speculative long positions could be gently retreating after the recent push higher in technology stocks and these highly speculative assets. Anyway, coming back to Asia. In Australia today, the Reserve Bank of Australia maintained its interest rates unchanged as widely expected by analysts. The Aussie dollar pushed above the 66 cents level, while the ASX index remained pressured lower by energy stocks there. While in Japan, the Nikkei index was flat today. In the FX space, the US dollar is better than in Asia this morning, but remains offered into the 50-day moving average. The euro dollar consolidates gains above its own 50-day moving average this morning, while the dollar yen benefits from a softer US dollar across the board and perhaps from some safe haven flows into the yen. The pair is now preparing to test its 200-day moving average to the downside and could break below this level in case of a US government shutdown. But the real safe haven action is happening in precious metals. The price of gold rallied to a fresh record high this morning in Asia. It is now trading near the $38.64 per ounce level in the overbought territory that is being mostly ignored by investors looking to benefit from the gold's ultimate safe haven status combined with the strong positive momentum here. Same is true for silver. It is now approaching the $50 per ounce level that has just not been hit back in 2011 but could very well be taken out this time around as appetite for precious metals is backed by a reduced appetite for the US dollar and US treasuries, by a reduced appetite also for traditional currencies altogether, including the euro and sterling, and the demand for hard assets when global inflation expectations are rising due to the global trade war. Voila. Elsewhere in the metal space, copper futures have been trending higher on a mix of supply shock and speculative pressure. Lately, a serious accident at Freeport's Grasberg mine in Indonesia, which is one of the major copper mines in the world, forced the company into a force majeure, spooking markets of a tighter output ahead. Meanwhile, global demand for copper and demand expectations remain intact. They are quite strong, especially from China, mind you, and traders around the world are rushing to position for a potentially under-supplied copper market in the medium to long run. That, combined with a soft US dollar across the board and the after effects of lingering tariff anxieties in the copper market, well, the outlook here remains comfortably positive. In the energy space, well, crude oil is not necessarily benefiting from the softening US dollar as you would expect it would, nor the intense tensions in Ukraine. News actually yesterday that OPEC would rather announce another supply increase in the month of November is weighing heavier on sentiment than the geopolitical risk and the soft US dollar, and the latter sent actually the barrel of US crude right below the $65 per barrel level yesterday in quite an ugly session for crude oil. Consequently, the latest bullish attempt in crude oil has been unsuccessful, and US crude remains within the $62 to $65 per barrel trading range, waiting for a meaningful positive or negative breakout for fresh direction. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below. And follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.